setup for next session is also ready. I would like to invite Aditya Lakhanpal, Director Global Markets and Security Services, HSBC India, in conversation with Kumar Rajagopalan, Vice President and Country Head India, Bangladesh and Dubai Operation at DISYS, for an insightful conversation on emerging trends in foreign exchange market. The foreign exchange market is a dynamic and constantly evolving sector for the global economy, and with couple of disruptions happening in the sector, this session will be very helpful to understand what are some of the emerging trends, why are they crucial for your business, and how it can provide a valuable insight and opportunities for SMEs to succeed. Over to you, Kumar.
Thank you all. So let me take a few moments. You all have a glass of water. If you don't drink water, take a Mentos just to forget the lunch, because it's 12:40, this session should start. Now it's 1:20. Forget about the lunch for some time, you can take some water. Okay? So we'll start with that one. It's not a cool subject, so Mentos can help you. Of course, about the Forex market. And being a CA, I left CA, joined the IT side of it, because I worked on a lot of Forex branches audits, and trust me, it's like kind of, it's not a easy thing. And lots of things are going on into that one, especially in this current market. If you really look at it every day, the dollar appreciating, dollar depreciating. You have a 3-year contract and suddenly you feel that like you don't have a profit margin. And then you go on to say that there is a war, and because of that there is a Forex fluctuations. And gold is increasing. There are so many variables. We try to find the orbit. It's a new orbit altogether. I don't see anywhere on any day you can guarantee that a dollar and rupee is going to be the same. On top of it, when we looked at it, 2008, we had the Lehman Brothers. 2015 to 17, we had problems in the NPAs in Indian banking system. And now, it started with SVB. And now it's spreading to other banks like Credit Suisse. Thanks to HSBC, they always maintain that like your banking partner. And they took over the UK assets of the SVB and settled some of them. More importantly, on the Forex market, always, I looked at it this way. Even though I'm a CA chartered accountant, the numbers always tumble. So I always talk about from India, 10 lakhs, and suddenly we have to mentally manipulate into 10 million or million, and then what's the dollar number divided by 75, 76. By the time we divide the number, the dollar value changes. And it's even more difficult to kind of convince the customer, what do we do here? And all these things, apart from that, today for this session, I wanted to ask few questions thanks to our friend Sami Jain. I asked ChatGPT. The first question which came to me is, do you have a problem in your family? So I don't even know what is the relationship between the Forex market and the family, but that's how it says. Then I asked Alexa. Alexa said, like, I don't predict. Don't ask me, you ask Mr. Putin or Joe Biden. Don't ask me about all these things because I cannot predict. With that, we all in SME, we know that like we cannot have an expert in this field in our company itself, leave alone like kind of having a daily guidance. We need a company, at least we need a banker who can provide our guidance to that one. With that, I would introduce Aditya from HSBC. First, initially when we started here, the chairs were apart. That's how I was with the Forex market. And slowly it started coming down, and suddenly again it drifted apart. So I was wondering whether am I close to the Forex market or not. Finally, this is the closest which I can get it, and probably this is the closest which I can get it from an expert advisor. So with that, I will probably start my question with him. Of course, I went through the HSBC's mission. opening up a world of opportunity for SME. This is what we are looking for. And they also said explain why they exist. Let's check with Aditya why they exist here and what are we going to get it. Thank you, Aditya.
Thank you for that very, very interesting and generous introduction, Kumar. Really looking forward to the conversation. I know this is that time of the day when thought for food overtakes food for thought. And this is not a topic which necessarily is very, very natural to most, but we'll try and keep the conversation a little interesting.
Yeah, thank you. Of course, like we all would like to know the key themes that are dominating in the current Forex market. Instead of going through all the papers, I thought it would be better to ask this question to Aditya himself directly and get his perspective around it. So let's start with that question.
Sure, thank you. So, as you rightly said, there are at all points in time so many variables that drive foreign exchange markets that it's very, very difficult to pinpoint what will really cause a change on the following day. But if I were to oversimplify this a little bit and list down two things that we think are dominating foreign exchange markets at this point in time, I think the first of these is the outlook on the US dollar itself. Because the reality is that the US dollar is the reserve currency of the world, and each currency is priced or traded against the US dollar for the most part. So therefore it's important to understand what's the outlook on the US dollar itself. The second thing that I think is relevant is to understand a bit on the macroeconomic space as to what's happening with some of the larger economies in the world, the US and the Europe primarily. And I guess that's also going to be interesting because those are where most of the customers for our audience here come from. So let me just talk quickly about the US dollar. What have we seen so far? If you see last year, the US dollar had a very massive rally. Between Jan and September of last year, the dollar rallied by about 20%. Why did this happen? Because there was a lot of inflation that was raging in the US. Some of us will remember that around June, inflation in the US was 9%, numbers they had not seen in 40 years. And as a result, a lot of the market participants started believing that the central bank in the US would deliver a series of very aggressive and quick rate hikes. Now, why was this relevant for the foreign exchange market? Because if you are an investor and you're holding a currency, you will always want to hold the currency which yields more relative to others. And at that point in time, all the other currencies were hardly yielding anything. And therefore, there was a big flight of capital into US dollar, and we saw the dollar rally quite a bit. This started tempering off towards the end of the year. If you look at the last calendar quarter of last year, inflation started plateauing out, and the expectations on rate hikes started becoming more subdued. And since then, we've seen the dollar weaken a fair bit. In fact, if you look at between September and Feb, the US dollar has given up almost half of those gains of last year. Now, what do we see happening from here? I think the inflation outlook that I spoke about is quite relevant. So inflation in the US is even today quite elevated. It's at about 6%. But the good news is that we are beginning to see a bit of tempering of inflation. Goods inflation has definitely cooled off. Services inflation continues to be high. What we are also seeing is that wage inflation continues to persist in the US, although not at the same pace as it was growing in the past. And the US Federal Reserve is quite clear that they do not think that wage inflation can keep coming through at this pace. And if wage inflation does not come through and it does not fuel inflation, then the outlook for interest rates becomes more predictable, and it's very, very likely that more rate hikes in the US are going to be less and less. So our house view, for example, on rate hikes in the US is that we probably see 2 more rate hikes. They delivered a rate hike last night. We probably see 2 more rate hikes in the US of 25 basis points each, taking the Fed fund rate to 5.5%, and they should pause after that. So that's one key reason why we think the dollar should not be that strong going forward. The other interesting thing that's also happening is that other central banks are also hiking rates. The ECB between last year and now, last year was the first time the ECB delivered a rate hike in 11 years. And since then they've hiked rates now to 3%. So the relative yield of the US dollar versus other currencies has definitely diminished. And therefore, that's another reason we think the US dollar will not find favor as much as it did last year. So this is what's reflecting in our forecast going forward, and we think the dollar should weaken over the course of the year. What does it mean for the audience here? I mean, all of these macroeconomic factors and that view on currency. So we're seeing a couple of things play out right now. First and foremost, higher interest rates mean that for most corporates, debt servicing costs are going to be high. If you have higher debt servicing costs, it probably means that your margins are tighter. If your margins are tighter, it probably means that there is lesser money to spend on tech projects, right? So that's one thing we think that can play out. The second thing, and this was referred to earlier as well, is the crisis that we've seen in the US in this month, right, with the Silicon Valley Bank going down. Now, a bulk of the turmoil has been seen in the financial sector. And therefore, most banks at this point in time are doing everything they can to shore up capital. And therefore, they're going to be spending less and less on projects. That said, banks have to meet regulatory requirements. So we think what will happen is that projects that are aligned to running the bank will probably find favor over projects that are aligned around building the bank, right? So new technologies are going to be more difficult to come by. But is it all gloom and doom? The answer is no. There's always a silver lining. And I think one of the things that we will see as a fallout of this entire cost pressure and cost focus is that there'll be more and more business processes which will probably be relocated to countries like India. And therefore, I think it's the GCC space which will probably see some benefit of that. We'll see more and more business being routed to countries like India.
Yeah, thank you. Thanks, Aditya. In fact, it's a valid point. In fact, too many things which happens at some point of time, the pressure on the cost, especially here, the margins gets eaten away by the foreign currency fluctuations. Especially last 2 years, rupee was sliding like anything, and now it's kind of at least stabilized. If somebody has a 1 to 3 year contract and things like that, and yesterday also there was a news floating around, a rupee agreement is possible with 18 countries and things like that. So what would you advise for a SME now to hold US dollars or to go after? So how would INR would behave against US dollars?
So I also don't have a crystal ball to know where this will end, but what are the things what we can do is we can always point people to what we think are the key factors driving the move in the INR, right? So if you think of the INR, like the US dollar, we saw the rupee depreciate almost 10% last year. And since then, as you mentioned, it's been trading a very steady range of about 81 to 83 for the most part. Now, if you have to have a view on the rupee as to how will it behave over the rest of this year, what are the things you should focus on? To my mind, India is very, very different from rest of Asia. And I think the trade deficit is something one should always keep their eyes on. Now, what is trade deficit? It's India's exports minus imports. If you think of China, they run a trade surplus. India as a country structurally has more imports than exports, so we run a trade deficit. Now, this trade deficit pre-pandemic was close to about $14 billion a month. As we came out of the pandemic, this number started looking much higher, and for the second half of last year, was averaging at about $24-25 billion a month. So that had us really worried, because we thought that would intuitively mean that there's a greater demand for dollars, because you're importing a lot more, and therefore it will weaken the rupee. But as things stand, in the recent months, it's tempered off. It's now at about $17 billion a month, so that's cooled off a bit. The other interesting observation we've got on India's exports is that service exports have picked up meaningfully. And if you look at India's net service exports, as recently as last year, they were close to $10 billion a month, and now they're trending at about $13 billion a month. And a large part of the delta is actually coming from the GCC space. So that we think is, on a longer term basis, going to provide a good offset to the trade deficit that we run as a country, and therefore is a positive. On the capital flow side, I think we are well placed. So FDI continues to trickle in at about $3.5 billion a month. And portfolio flows, which is, FPI is putting money into India's equity markets and debt markets, that while it's been a net negative, but it's not a very large number. So rounding it up, what we think is that from a flows point of view, we are in a good place right now. Our trade deficit is not going to be a drain on the currency, and therefore rupee probably continues to trade an 81, 83 kind of a range in the near term. Now, one of the questions I get asked therefore is that, does it really make sense to hedge your exposure? And that's something we often recommend to our clients when they have, longer term contracts. And in the context of India, of the Indian rupee, I think it's a fairly relevant question, because what most of my exporter clients tell me is that, over a long period of time, rupee keeps depreciating, so why should I really hedge? And if you actually look at data, so if you look at the last 10 years, the rupee on an average has weakened about 4% every year. And therefore, there is a lot of strength to the argument. But there are a few things to kind of keep in mind. To me, the most important one is that if you look at the data for the same 10-year period, and if somebody were to consistently hedge, the average forward premium they would receive, which is the interest rate differential between the two currencies, would have been about 5%. So basically, for every year that you put on a hedge, you earned 1% more on your exports versus not hedging. And I'm not even getting into the value of compounding that can come in, right? So that's one. Second, in the segment that we are talking to, one of the key input costs is wage. And hedging, or that 5% premium, provides a good offset to the wage inflation that you otherwise experience. Third, while more recently we've seen a deterioration in the interest rate differential, but even now, if you look at the last 6 months, the rupee has weakened by 1.5%, and the forward premium is still 2.5%, so there's still a 1% delta. So all in all, I would say that it does make sense to hedge exports. Conversely, it probably does not make sense to hedge imports just as much, but it does make sense to hedge exports. But the key or the mantra is that you just have to do it consistently. If one tries to bring an element of judgment into this, that's when things start to go wrong.
Fantastic. So, though it's time up, I don't want to miss this question. Of course, like you said, there is no mantra. And with the 8,000 customers you have, of course, one is the banking and the authorized dealer kind of a role. The second is advisory. And I can tell you, you guys are fabulous in terms of advisory, most of the customers. And I know SME can benefit out of your advisory services. If at all, if you wanted to give a best advice on the best practices that they need to follow and the bank can provide that one as an advisory, what would it be?
So I mean, there are a few things I could talk about. The one that comes to me is that increasingly India is becoming more and more digital, right? And what we are trying to do as a bank is we are trying to align to that. We are not trying to force fit global solutions into India. We are actually trying to build India-specific solutions. And there are a few tools we've built which we have seen our clients really benefit from. So for example, we've got something called HSBC UniTransact, which is a platform that can be used by clients to manage their entire payment lifecycle, cross-border payment lifecycle online. It's a very nice dashboard on which they can see everything that they have to do. A lot of exporters often face challenges in how they do their export regularization, how FIRCs are issued, how export regularization is done. We've got a digital tool that enables this to be done through Digitrade online. So there are digital tools that we are building that really help. We also are focusing a lot on the segment. Today we've got 7,500 clients in the SME space, covered by about 250 bankers. And we do appreciate that at times SMEs may not have the resources to upskill their own employees. And therefore what we are doing as a bank is to ensure that we come in and help with that through training sessions, through workshops, and through our online tools that we have. So we're quite keen to grow in this space, and I'm sure that over the next few years you'll see a lot more of us in this space.
Thank you, Aditya. Before I pass on, in fact, I spent a few minutes in their booth, asked about some other questions about very specific to SME and their solutions. It's fabulous the way they presented it. I guess you guys can benefit it, like you can visit their booths here and get the information out of it. I'll pass on the mic if you have any question, one question which can be taken. Yep.
So since you talked about dollar being the global currency, since US is printing dollar like anything, as you can see from the data, so what do you think about the US dollars long-term future? Do you think any other currency will replace the US dollar as a global currency, or Bitcoin will replace dollar as global currency in the long term?
That's a very good question, and one we get often. I have to say that the dollar's reserve currency status has been questioned many a times. And more recently with some of the geopolitical situations that have unfolded, say Afghanistan or Russia. But the reality is that there isn't anything, any asset class in the world which provides the liquidity or the safety that the US dollar does, right? So it's very, very difficult for this to happen overnight. I'm not saying that this is not a direction that the world is increasingly moving towards, but I think it's going to take some time for this to really come through because, you know, even today, despite everything that's happened in the last 2 years, 60% of the world's FX reserves are held in US dollars. And if you think of alternatives, you know, what are the real alternatives? Euro? Possibly yes, but you know, let's just go back a few years and the entire existence of Eurozone was at some point being questioned. The RMB is an alternative, the Chinese yuan, but again, it's not as liquid and as easy to trade, especially when you think of going onshore. Gold has also been considered as an alternative several times over, but again, it doesn't offer the liquidity that US Treasuries does. And I'll just give you one statistic to make this point. Following the SVB situation that we saw earlier this month, about $150 billion of capital moved into US Treasuries. So just contextually, that is equal to the net service exports that India has in 1 year. In 2 weeks, that's the amount of money that moved into US Treasuries. So that's the amount of liquidity that the US dollar and US instruments have to offer, and therefore, it's a direction that people are moving towards. So reserves are being diversified, but I don't think it's going to happen anytime soon.
So isn't it true that dollar is, I mean, US is just printing the dollar like anything, there is no tomorrow, I mean, there is no basis around that, so this bubble must burst sometime.
They are. I mean, see, with COVID, most central banks ended up loosening their balance sheets, most governments ended up spending a lot of money, so it's all relative. And on a relative basis, yes, the US may have expanded their balance sheet a lot more, but honestly, they have the ability to do it because they are the reserve currency, because they have the liquidity to provide to the rest of the world, and therefore, at this point in time, it's not really a cause of concern.
Thank you, Aditya. Thanks a lot for...
My pleasure, Kumar. Thank you.
For such an interesting and insightful discussion, here is a small token of gratitude from our end to both of you.